The vast majority of banks are insured by the FDIC, although some choose smaller deposit insurers. If an FDIC-insured bank fails, the government-backed agency protects consumers' money by selling the bank to another financial institution or paying depositors directly up to $250,000. So in this video, we are going to discuss what happens to your money if your bank collapses. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. If your bank is sold, your money is typically available in your new account within 2 business days, and your terms and conditions stay the same, said Levin Galstian, CPA at Oakview Law Group. However, it may take longer if a large number of depositors are affected by the bank's failure, he added. Direct deposits, pending transactions, and bills after a bank failure. If your bank is acquired, you shouldn't need to take any action. Your deposits should be redirected automatically to your account at your new bank. However, if there's a delay and your accounts aren't immediately transferred to another bank, you might need to reach out to your employer and have them temporarily redirect your paycheck to another account. In any case, it's a good idea to keep track of your direct deposit information and to update it as necessary if you change banks or if there are any changes to your bank account information, said Galstian. This can help ensure that your direct deposits continue to be credited to the correct account and that you have access to your funds in a timely manner. Keep in mind that direct deposits and pending transactions differ during a bank failure. Transfers and checks in process may be returned unpaid, said Denis Chershikov, a finance, economics, and accounting professor at the City University of New York and head of growth for awning.com. You may need to make alternative arrangements to cover any outstanding payments or bills. After a bank failure, outstanding checks and payment requests connected to your original account won't be able to process. But don't worry, this doesn't affect your credit, according to the FDIC. Just make sure to pay those bills from your new account as soon as possible. How to protect yourself against a bank failure. Although bank failures aren't common, they still happen from time to time, whether due to poor management, economic downturns, regulatory issues, fraud, embezzlement, or cybersecurity breaches, said Galstian. Thankfully, there are several things you can start doing to protect your money from that risk. Spread your money out across several banks. If you have more than $250,000 in an FDIC-insured bank that fails, you can receive a claim against the bank's estate for the extra funds. It's much safer, though, to spread out your assets across several institutions so you don't exceed the insured amount, said Chershikov. Choose a well-regulated and financially sound bank. Look for a bank that's insured by the FDIC or another deposit insurance agency, has a strong balance sheet and financial performance, and has a history of responsible management, said Galstian. To guard against errors or fraud, you should also monitor your account activity and statements regularly, he added. Be sure to report to your bank any suspicious or unauthorized transactions you may see. Stay informed. Staying up to date on financial news and trends can help you spot warning signs of instability at your bank so you can make the best decisions possible for your accounts. Some warning signs of potential financial trouble for a bank may include declining stock prices, negative news reports, management turnover, or regulatory enforcement actions, said Galstian. However, it's important to note that a bank's financial condition is complex and challenging to understand from the outside fully. Silicon Valley Bank, SVB, has been dominating headlines and financial markets in recent weeks after it became the second largest bank collapse in U.S. history, followed shortly after by New York-based Signature Bank. With more than $110 billion in assets, Signature Bank is the third largest bank failure in U.S. history. Silicon Valley Bank has since been acquired by Raleigh-based First Citizens Bank, and as of today, the 17 legacy SVB branches will begin operating as Silicon Valley Bank, a division of First Citizens Bank. In a statement from First Citizens Bank, it was noted that current customers of SVB will not face any immediate changes to their accounts. They will be able to continue to access their accounts as they do today, through their current websites, mobile apps, and branch locations, They can continue to use their checks and cards and will still have ATM and online access to their accounts. Loan customers should continue making loan payments as usual. Customers will be notified of any future account changes in advance. While this newest advancement may bring peace of mind to some, these recent failures have shed light on the fragility of the banking sector, with many consumers and investors alike questioning just how safe their money is. What is a bank failure? According to the FDIC, a bank failure is defined as the closing of a bank by a federal or state banking regulatory agency. This typically happens when a bank is unable to meet its obligations to depositors and others. In the case of SVB, the culprit was a bank run. That's when depositors rush to withdraw all of their funds all at once amid fears that the bank may fail. As more customers withdraw their money, it increases the likelihood that the bank will default and run out of cash. There was a sharp rise in bank failures during the 2007 to 2008 financial crisis, but the banking system hasn't seen failures in such high numbers since then. In the event of a bank failure, the Federal Deposit Insurance Corporation, FDIC, steps in to offer insurance coverage up to a certain limit per depositor per bank for each account ownership category. The FDIC also acts as the receiver of the failed bank, meaning that it sells and collects the assets of the failed bank and settles its debts, including claims for deposits in excess of the insured limit. The problem, the FDIC has its limits. Knowing what those are can help you better protect your funds. The FDIC protects $250,000 of deposits for each depositor, and keeping balances below this will certainly protect you from a fallout like we are seeing with SVB, says Lawrence Sprung, CFP and founder of Midland Financial. You may have a delay in accessing your funds, which may have consequences of their own, but you will eventually get the funds. This is merely a way to protect those deposits from disappearing, as over the $250,000 limit you most likely will be out of luck. Where to put your money if your bank has failed? If your bank fails, you'll immediately receive written notice from the FDIC via mail. In many cases, you can expect to receive your money in a timely manner. According to the FDIC, federal law requires that it make payments of insured deposits as soon as possible upon the failure of an insured institution, usually within a matter of days. If you were impacted by recent bank closures or find yourself in a similar position in the future, there are a few ways you can protect your funds. Bank with an FDIC-insured institution. The FDIC's Bank Find Suite can help you determine if your bank is FDIC-insured, or you can contact the FDIC by phone to verify that your bank is a member. Consider alternative account types. If your deposit account contains a balance that's higher than the $250,000 limit, you have some alternative options that allow for a higher limit, such as the Certificate of Deposit Account Registry Service. The catch, a Certificate of Deposit, CD, requires that you tie up your funds until your CD reaches its maturity date. Many banks also offer cash management solutions that will provide FDIC insurance above the $250,000 limit too. As an example, let's say you need to keep $1 million in a bank and want it fully FDIC insured. They provide one account for the deposits, and then they will, behind the scenes, divide your deposit among 5 different banks, which will have no more than the $250,000 maximum each. Bank A, B, C, and D each have a deposit of $250,000. And then once any interest is credited, the bank would introduce Bank E to assure all of your deposits are fully insured, says Sprung. Not every bank has this or does this, so it is important to know who your deposits are with and what is insured. Consider opening an account at a local credit union. Another option could be to explore keeping some of your money at a credit union. Credit unions are also a good option to see if they can provide you with the coverage and what you need from a banking relationship. They may also allow you to put money in additional banks in your local area, says Sprung. Credit unions are insured by the National Credit Union Administration, NCUA, and it offers coverage up to $250,000 per share owner per insured credit union for each account ownership category. You can visit the NCUA's credit union locator to find an NCUA-insured credit union near you. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.